they're talking about it. So
That who had what spring break? Sorry, I didn't follow that piece.
because on channel one, which is
Mm.
because on channel one for the on the news,
Yeah.
New York One, it was saying that we're gonna have the spring break. Like everyone like is entitled to it or something like that, I heard.
Oh, yeah, so there's a lot of confusion even with K through 12 because they took the governor took the spring break away from from the schools, the K through 12 schools completely, which caused a whole massive uproar because everybody's exhausted, obviously the teachers and the parents. But that's, I don't know if that's what you heard about. I mean, I didn't watch this news thing, but just to be clear, unfortunately, K through 12, which is the young kids up to high school, are not having a spring break at all.
Yeah.
The four-year colleges in the CUNY system, along with some of the community colleges, but not us. LaGuardia is definitely carved out of this. They're not having spring break really. It's only the few days of Passover. I think it's only the 8th to the 10th, like Good Friday and Passover, whatever, that they are actually giving them. But we are off completely from Wednesday the 8th to Thursday the 16th. Now, during that time, I mean, as would normally be the case, some faculty may give you, work to complete, to hand in by the end of spring break. I mean, that's kind of normal. Like that's what people would do if we were in our normal circumstances. However, I'm not giving you guys anything to do because of the situation. Like it's so, everything is for everybody is just so crazy that I just felt like everybody just needed a break, basically.
Yeah.
So we won't meet, and we also won't have anything due. You can go right ahead and study or do whatever you want, but the dates, coming back, we will still have instruction and stuff on the 20th, and the test for and quiz for chapter 13 and 14 will open on the 26th. I mean, all these dates are on Blackboard, and then will be due, I believe, on May the 3rd. So I just pushed everything back. Does that help to answer your question?
Yes. I'm going to do some read, study, and practice like over the break, so I can just be clear of the work like a little more, like.
Yeah. So I had promised you guys, and I'll still do it, that when chapter 13 is due, which is today at 11:59 p.m., when that's over, when the homework is due, then I'll put up the solutions for the back of the chapter, homework examples for chapter 13, so that if people still want to do extra practice, which I highly recommend, then you can just select questions, in either the brief exercises or the exercises, or do it, or the problems within the chapter, and you can actually just practice some more. So definitely do continue to practice. It's the most important part of the class, is being able to work through the problems on your own. And I'll be around. I'm not obviously going anywhere. So if people have some crisis, or you have some question or something, of course I'll answer my email. So if you guys are practicing and you run into trouble, or you weren't able to finish the homework, but you decide that you now want to tackle the homework after the fact, I'm still around. So I'd be happy to support people, because I actually think this week and a bit is a good time, whether for this class or even other classes, for people to just catch up and practice and kind of just get their bearings, if you have the time to do it. I mean, I know everybody's situation is different. People may be dealing with sick family members and dealing with children who now don't have spring break either. So, do what you can.
Yeah.
All
All
right.
right. Thank you so much, Miss.
No worries. You're welcome. Any other questions? Well, first of all, good morning again, and good morning to those who are joining. I'll make sure that I've got you all on the attendance. But
Morning, Professor.
Yeah, hi, Leah. I have some answers for you, by the way. Also, you asked me questions last week, but let me hear what you want to ask me now.
Okay. I don't have question right now.
Oh,
okay.
you're just saying morning. Okay, so let me
Yeah.
actually just tell you some stuff. I believe it was you who asked last week. You did ask about graduation, I think. Am I remembering this correctly? And I
No, it wasn't me.
okay, so
Someone
then
else. Yeah.
let me just talk about this stuff anyway, in
Yeah, sure, no
case
problem.
it's applicable to somebody. So I'm just gonna share my screen with you guys, and go to you guys can see my screen, right? Can someone just confirm?
Yes.
Okay, so I'm going to a page on CUNY's, the main CUNY website. I was given a link to this page by my boss, by the chair of the department. And basically, I'm not going to read through, every single word that's written here, but I just wanted to say for whomever asked about commencement, it's definitely postponed. Commencement being the walking in the graduation, because, and it's like I said last time, that this gathering of many people is prohibited at the moment. But just like we said last week, obviously if you're set to graduate this semester, the fact that you're not marching in a ceremony is not going to be impacting your sorry, just hang on, what am I doing? 1 second. Is not going to be impacting your diploma. And then they said maybe, at some point at a later stage, they will try and find a way to mark this rite of passage, but there's absolutely no guidance right now on how that's going to happen. And then the second thing that I wanted to say was, and someone may have asked me this in this class or in my other class, is what's happening with the summer classes. So, if the classes that start on June the 20th, those are all going to be what they call distance learning, meaning online. So if you have classes for spring session 2, at the moment, the guidance is that those classes will also be via distance learning. We are not going to come back to the campus at this stage to have those spring 2 classes. We don't know about fall 2020. I suspect we may be back, but it's still also back to campus, but it's still under discussion. And then one thing that I also wanted to point out, I'm just going to try and go past all this other stuff. Grading policies. So I don't know if in any of your other classes they've brought this up, but basically, because of the nature of all the things that are going on the semester, the grading policy, the Board of Trustees decided that students will actually have the option to convert any or all of the letter grades that you earn in your classes this semester to credit or no credit. So, that sounds confusing, but basically what it means is you can decide whether you want a course. So if you're staying in the course and you're trying to complete it, but in the end, maybe the grades aren't what you are hoping for, you actually have the option for the class not to count towards your GPA. So that's what no credit means. And you're able to make this decision up to 20 days after the final grade submission deadline, which for us is June the 15th. But you just have to be careful, because if you decide credit or no credit, once you make that decision, you can't reverse it. And let me see here. And if you choose this option, a passing grade will convert to credit, a failing grade will be no credit. And obviously the credit or no credit grades will not impact your GPA. I'm still, trying to make sure that I understand this well. I don't think I understand it as well as I need to. So I'll probably be speaking with my boss during the spring break to make sure that that I'm giving you proper guidance, but I did just want to give you a heads up that I'm trying to see if there's anything else. Yeah, oh yeah, there's one more thing I need to mention. I'm just trying to give you a heads up about this credit, no credit business, because it could be possible that by the time we get to the end of the semester for some of your classes, or maybe even for this class, you feel that things are not going the way you wanted to go, and it's too late to withdraw, or you don't want to withdraw for whatever reason. So then this credit, no credit thing is an option, and it won't impact your GPA. It says that, you know, when we look at transfer, you will be able to transfer the course across the colleges within CUNY, all right? But if you transfer outside of CUNY, you wouldn't be able to transfer those courses. Again, I'm also only learning about these things as we go along, so bear with me as I get more information. I will share it with you. The W last day to drop with a grade of W, that this is for us, it's June the 4th. So do you see here, we're lag, LAG, so it's June the 4th. This is the dates for the other schools that end a little bit earlier than us. So if you still feel that you are not comfortable with where you are at in any of your classes, you have until June the 4th is basically the last day of class for us. You have until June the 4th to actually decide that you just want to withdraw, and a W will appear on your transcript. For session 2, if you take those classes, and remember those classes are also going to be distance learning, you have until August the 1st, which is also the last day of the classes for session 2, to withdraw. But remember, that's the final day. So don't wait until midnight that night to withdraw. And if something goes wrong with the computer or something, you can't get out of it. If you really think you're going to withdraw, you're probably better off just even withdrawing a day earlier. I'm going to stop sharing now, and questions, guys. So everything's clear. I think probably the biggest reprieve that we have is the fact that that you can wait to withdraw from classes. I mean, you can basically see almost right till the end whether you want to stay in the class. And I guess the other thing is this credit, no credit. But like I said, I have to be honest, this credit, no credit, what does grade W mean? Yeah, someone's asking, what does a W grade mean? It means that you withdrew from the course without completing it. And you know, that has implications, because remember, if you are on financial aid and things of that nature, you probably want to speak with someone from Student Financial Services before you withdraw from any course. What I'll also say is, if you do withdraw and you get a W grade, then when you retake the course, if you retake the course, then whatever grade you get for the course will replace the W grade. The question is just whether, if you have financial aid, whether financial aid will pay for the course twice. So that's the only issue with withdrawal. It's, you know, does it push you back a semester? And also, if you are relying on financial aid, you know, sometimes withdrawal can actually result in you having to pay out of pocket when you take that class again. So you just want to be very careful about how you strategize around that. I am busy taking the attendance. Someone's asking me if I'm taking attendance because they came late. Absolutely. The attendance is ongoing. So anybody who showed up a little bit after we started, I just keep checking off names during the call, because you don't hear it, but I hear a sound every time someone joins the call. So then I just check to see who it is that joined, and I check them off on the attendance. So please don't worry, I have your attendance. Any other
I got kicked out and logged back
administrative?
on.
Huh? Sorry, what?
I think I got kicked off and logged back on. Is that okay?
Yeah, but I got you already, and plus you wrote something in the chat box, so you're definitely in attendance. So don't worry. Also, reminder today I do have office hours at 1 o'clock with the same Zoom meeting ID as before. If you need help with something, whether it be the homework that's due or some other thing, you can come to the office hours. I'm trying to think, does anybody have any other administrative questions for me, whether it be about spring break or about grading or anything of that nature?
Miss, I have a question. I know like certain teachers, I don't know, it was probably just one teacher I had before. When they round your final grade, they rounded like 5 points up or 5 points down. Is that the case, or it's just whatever, you know?
So I start rounding from 0.5. So let's say I mean, the grade guidance is that you should round from 0.9, but you know that's a little bit excessive as far as I'm concerned. So if you have, let's say 82.5, I round you up to 83, so then you go from a B minus to a B. But I'm not round, so it's 0.5. So I'm not rounding, you know, 5 and 10 and whatever points. It's basically if you're on the borderline. Because you're 0.5% away from the next letter grade, I'll absolutely round you up. I obviously don't round anybody down. Yeah, does that help?
Yeah.
Okay. All right. So other things, someone just asked me in the chat window, when is the test? Is the test happening before the break? No, the only thing that's due right now is your homework, chapter 13 homework. So I'll just go into Wiley. Sorry, this is the wrong view. I was just looking up something before we started. So if I go to student view 29, so you go to your assignments. The chapter 13 homework is due today at midnight. You know, those are the questions. A lot of people have emailed me to ask for help and things. You don't have multiple attempts because I'm trying to encourage people to actually read the text before they start, you know, just guessing stuff. But certainly you can contact me for help because I can try to, you know, stop you from having to try over and over. It's getting late, obviously. If you haven't started this, you are running late because it's a lot of work to try to finish in one day. So these are the homeworks. You can see when they're due. You can see that the chapter 14 homework is only due a week after we return from spring break. And if I go to my view, I'll show you. It's the assignments for the test and the quiz release on a particular date. So your quiz 1 and test 1 will open on the 26th of April and close on the 3rd of May. So it's basically a 1 week window that you have, not that you have a week to do the test and the quiz, but you have within this 1 week period, you should set aside, remember I increased the time, you should set aside 4 hours where you can just sit and, well, for the quiz I gave you 2 hours, although it's only 10 multiple choice questions. And then the test is 4 hours, although it's really written to only take 2 hours. But because I know the internet has been sketchy and all kinds of things are going on with people, I'm giving you some extra time. So nothing is, besides today's homework, chapter 13, nothing else is due before the spring break. Okay, so Your chapter 14 homework is due on the 27th. But it's available. You can start it, and then your test and your quiz are only going to come onto Wiley Plus on the 26th of April. And the reason I do that is because I don't want people to start doing the test and the quiz before the time, and then before we've actually finished the material, and then running into problems. Because it might seem like, oh, it shouldn't be too bad, I'm just going to start it, but then in the end it's actually possibly harder than you might anticipate. So you'll have that week, plan that during that week when it's basically the second week after we return, that you set aside some time to be able to do this work, and then things will roll from there. Remember, I gave you the due dates and stuff over here on Blackboard, so you can see when things are coming due. All right, so I guess, I don't know why today I can't, I don't have the little, it's odd. I don't have the little screen thing that controls the sharing on my screen. In any case, I'm going to start chapter 14 unless there's any other questions. Well, not start, but continue where we left off, unless anybody has anything else they want to ask me. All right. So let me go back here and go into the notes from the last time. So we said that, I guess, let me just warn you that because I'm not seeing the little bar on the top that normally shows me, everybody, and also if someone's asking something on chat, I don't know why that's happening today. If you have a question, you're going to have to ask, you're going to have to speak to ask the question, because I can't see the chat window. And then secondly, if your mic isn't working, then just type it, but I'll have to deal with it when I come out of the share. Zoom has made a few changes. I don't know if that's why I can't see this thing. I doubt it. It's probably just some other issue today. So we finished up chapter 13 last week, and we started a little bit with chapter 14. I said that 13 and 14 are kind of connected, because in 13 we spoke about issuing stock, whether it be common stock or preferred stock, and the balance sheet and so on. And in 14 we're talking about dividends, which are payments that the company makes from profits that are generated, and also retained earnings, which we discussed also in chapter 13, is the net income that the company holds back, that they aren't actually distributing. But when they do decide to make a distribution of dividends, it's distributed out of retained earnings. And then the last piece that's going on in this chapter is income reporting, which is really referring to building an income statement. And I had said last time that an income statement for a corporation or company is different from what we saw for our sole proprietorships and our partnerships, because companies are a separate legal entity. So they are in fact taxed in their own capacity, which means we'll have a line on the income statement that says income tax expense, which is, slightly different, not slightly, but is different from what we've seen before, because for all the other forms of business, the owners are taxed individually. So the income flows through the company or the organization and to the owners, whereas with a corporation, the income is taxed in the corporation. So a dividend is paid to me in a proportional manner, pro rata. So if I have one share and the company declares a $1 dividend per share, I get $1. If I have 2 shares, I get $2, and so on. Dividends can come in many forms. We spoke about this a little bit also, but we said we will focus on a cash dividend and a stock dividend, right? Those are the two we need to be concerned with. We don't have to worry about a company distributing property or anything like that. Dividends could be expressed as a percentage of the par or stated value of the stock. We saw this in chapter 13 right at the end when we were dealing with preferred shares, we saw that you use the percentage, right? That's one of the features of the preferred stock. As the part of the calculation of the dividend. So this percentage approach is predominantly related to preferred stock. And then we also have a dollar amount per share, which is the more common way to do the expression of a dividend for a common stock. And last week, we also spoke about the 3 dates that are relevant. Remember that no one is entitled to a dividend until the board of directors declares that dividend. So when you're thinking about the declaration of the dividend, you have 3 dates that you need to be keeping in mind. There's the declaration date, which is when the board of directors says that I figured out what the problem was. There's a declaration date where the board of directors says that we are going to pay a dividend. And then there's the record date, which is where they go through their records and figure out who owns the stock. And then the final date is the payment date, where they actually distribute either the cash or the stocks, depending on what form, excuse me, the dividend takes. So remember, for the declaration date, we were saying that this is when we actually tell the stockholders that we are going to pay them something, which means at that date, a liability comes about. Before that date, no one is entitled to anything. Even if you have cumulative preferred stock, you can't go in and demand that they pay you something. All you can do is wait until they declare a dividend. And if they haven't paid you your dividend amount for X amount of years or whatever, they will then have to pay you the preferred stock first, everything that's owed to them, before the common stockholders can get anything. And as it relates to the conditions that have to exist for a cash dividend to be paid, the company actually has to have retained earnings, meaning there must be profit that the company held back that it is now able to distribute to the shareholders. If the company is in a loss position, then obviously there's nothing to distribute. And this is the case even if it's a cash dividend or a stock dividend, because even though the stock dividend is paid in the form of shares, the transaction still involves a reduction of retained earnings. So if you don't have retained earnings surplus, then you won't be able to pay a dividend. For cash dividend, you obviously need to have the actual cash that you're going to pay, and then you have to declare the dividends. So when we look at a journal entry here for cash dividends, the debit goes on the declaration date. The debit goes against an account called cash dividends. This cash dividends account is not a permanent account, it's a temporary account, and it will eventually be paid. It will eventually be closed off to retained earnings. So in reality, cash dividends is almost like a holding account where you put the dividend, but in the end, it's a subtraction from retained earnings. And then the credit goes to dividends payable, and dividends payable is a current liability. All right, so that's a liability, but it is expected to be settled within 1 year from the balance sheet date. And then we have the record date. Again, no journal entry. The company is just determining who owns the shares so that they actually pay the dividends to the correct party. All right. Obviously the shares are trading on the stock exchange, which means the company isn't always, knowing who owns what. So on this date, there's a lot of work that goes into basically looking at an ownership register to see who owns the shares and also how many shares they own, so that they can be paid in a proper proportion to their ownership. And then the final journal entry is to settle the liability that was created over here. So a liability goes up on the credit side, and when we pay the liability, it goes down on the debit side. And obviously we're paying it out in cash. Cash is an asset. The asset decreases on the credit side. That's why we're crediting cash. So over here it says that the cumulative effect of the declaration and payment of the dividend is to decrease both stockholders' equity. Retained earnings goes down via cash dividends, and so does the asset cash, which makes sense because we're saying we're paying cash to the stockholders and we're paying it out of the retained earnings that we've been holding back. Questions up to there before we do an example? See if anybody is asking me questions on the chat. All right, so if there are no questions, then I will go to the exercises. You should have access to all this information. Remember, under Zoom call materials, we've got the chapter 14 notes, we've got the chapter 14 exercises, right? So that's what I'm busy with right now. All right, so this first example is, you know, somewhat straightforward, but I mean, I'll take my time here. Let me just see, and I need to probably create a blank sheet here. Yeah, so that we can work together. All right, so I'll take my time to just go through it so that you can see how the three dates play out. All right, so the declaration date, the record date, and the payment date. On December the 1st, 2018, the directors of Media General declare a, so there you can see that this dividend is declared as a dollar amount per share, right? 50 cents per share dividend on 100,000 shares. So remember, it's pro rata, meaning that the dividend is dependent on the number of shares that are outstanding, and also whatever someone receives is dependent on the number of shares that they actually own of $10 par value common stock. Now, can someone tell me, do you think we're going to use this $10 par value in the calculation of the dividend?
No?
Yes, that's correct. The answer is no. Because remember, the only time when we use the par value is when the dividend is quoted as a percentage. Remember, yeah. If it's a percentage of the par, the stated value, then we will use the par value in the calculation. If it's not, if it's just stated as a dollar amount per share, which is the case in this example, then you will ignore the par value and just focus on the dollar amount per share. So obviously you're saying 50 cents per share for 100,000 shares. So it must then mean that the dividend amount is $50,000, right? So let me set myself up here. You guys set yourself up as well. So you're doing debit. Let me just make this a little bit bigger. Okay, debit, credit, and it's December the 1st. What am I doing? Sorry. Okay. So December the 1st, and you're going to debit, just like we were talking about this account, cash dividends, which will eventually close to retained earnings. And you're saying 100,000 shares times 50 cents per share. That's where the 50,000 comes from. And your credit is to create that current liability, dividends payable, to show that we owe some money that we will be paying in future. And this is I just want to remind you that this is on the declaration date. Any questions up to there? It's pretty straightforward, right? Hopefully. So now on December the 22nd, which is the record date, it says that the record date for the dividend is December 22nd, 2018. That's great. So what now? Nothing. And you won't have to do this in Wiley, but I'm just writing it out here. No journal entry, because the record date is not, there's no transaction on that date. It's simply the company going through their records to see who they should pay. And then when it comes to January the 20th, when they actually pay the dividend, so now if you think back to the theory, right, on the payment date, you get rid of the liability and you credit cash because you're paying cash. So that's what we're going to do. That's January, January the 20th. So you're going to debit dividends payable with the same amount, right, 50,000, and you're going to credit cash with 50,000. Okay, just checking if anybody's asking questions. So those are, that's, you know, kind of a transactions broken up into the 3 dates. That's it. Declaration date. This is the, sorry, I should have probably put here so that you can remember the record date, and this is the payment date. Again, you don't have to put these narrations. I'm just putting them there so that you can remember what we were talking about. All right, so why don't you guys go ahead and try to do number 2. I'll read it with you, and then you can see if you understand how to apply the journal entries. So number 2, Bright Corporation has 100,000 shares of common stock outstanding. It declares a $2 per share cash dividend on September the 1st. There's the declaration date. To stockholders of record on October the 1st, there's the record date. The dividend is paid on October the 31st. There's the payment date. Journalize the entries on the appropriate dates to record the declaration and payment of the cash dividend. So take a few minutes, maybe 5-6 minutes, and go through and make the journal entries that you believe are appropriate for this question. I'll continue to take the attendance.
Miss, can you please just go back to number 1 so I could just take a picture of it?
Okay, I can even stay here. I don't know if everybody has the question, so I don't know where I should stay. If I should stay on the answer or on the question side.
I just took a picture of it. It's up to you if you want to go back.
Okay, so you took a picture, so
yes,
then
I just did.
I'll go back to the question.
Okay.
So, okay. I'm just stepping away for like 1 minute. I'll be right back.
Hi, Professor. Can I give it a shot?
Sorry, 2 more minutes, then you can give it a shot, okay?
Okay, thank you.
All right, you guys can wrap up your answers now, and then Jimmy, maybe give it another 10 seconds or so, then we'll go through the answer.
The declaration date is September 1st.
Okay, so we're going with September 1st. Yes, I'm listening.
And then the cash dividend is 100,000 shares times $2 is 200,000.
Okay.
200,000, yes.
And then the dividends payable is 200,000 to credit.
That's the current liability, dividends payable. That's correct. So that's
And
the
then
declaration date, everybody. Yeah.
And there's no record amount for October
Right.
1st.
So October the 1st, I mean, if you guys didn't put no journal entry, that's fine, but I'm just putting it so that you will always know when you look back on your work that you didn't forget something. There really doesn't need to be a journal entry there. Continue.
And October 31st is the payout for the dividends. So it's dividends payable.
So we're going to debit the liability because it's decreasing with the full amount that we're paying out.
And then credit to the cash dividends.
Yep, not cash dividends, just straight cash, right?
Oh, sorry,
Be
cash.
careful here. So cash is just the cash account. Cash dividends is the temporary account that records the dividend amount until we close it off to retained earnings. Thank you, that's correct. So questions here, anybody about anything that you may have become confused with? Too easy, right? All right. Let me check the chat before I get ahead of myself. Maybe someone's asking me. Oh no, no one's asking anything. All right, so people are feeling somewhat confident. So let's make this a little bit harder then, right? As usual. All right, so I'm looking at number 3, and we're going to not just have dividends here, there's other stuff happening as well. So number 3 I'll do with you, and number 4, because number 4 is going to be allocation of dividend between common and preferred stock. So please pay attention here to number 3 and 4. You also want to pay attention to how the questions are written. So for number 3, on February the 1st, Slavin Corporation they already had 65,000 shares of $5 par value common stock issued and outstanding. We know that issued is what was sold to outside of the company, and outstanding is what is still outside of the company. So in this case, there's no treasury stock or anything. Everything is still outside the company. So if they pay a dividend on this amount of shares, it all goes to the shareholders outside the company. During the year the following occurred. On March the 1st, they issued 35,000 additional shares of common stock for $12 per share. Now notice how this transaction is not a dividend declaration, right? It's a stock issuance. So remember I said that chapter 13 and 14 are linked to each other, not just because of the dividend, but there's also an assumption that you remember how to do a stock issuance. So, please don't treat them as two separate chapters where you don't have to really think about 13 if you're in 14 or think about 14 if you're in 13. That's not the case. On May the 1st, they declared a cash dividend of $1 per share to stockholders of record on July the 30th. And on August the 10th, they paid the $1 cash dividend. So notice how this question is written. Journalize the journal entries required for the transactions above. So because we're in a dividend chapter, we might think, oh, we just have to journalize the dividends, but because they talk about all the transactions above, we actually have to journalize the stock issuance as well. So I'm going to, toggle between the I guess the questions and the answers. Let me just put debit and credit down here so that we can still keep track of where we need to type. All right, so this is example 3. And if we go back, do we need to journalize these 65,000 shares? Do we need to make a journal entry for these shares?
No.
No.
No, we do not, right? Because these are shares that are already in existence. They've already been issued. So journalizing this would be double counting. And in any case, you don't have enough information to journalize them because you don't know what the issue price is. So this you just treat as the beginning number of shares that are outstanding. But certainly on March the 1st, you have to journalize the 35,000 shares. So that's March the 1st.
Cash for 420,000.
So we're going to go through exactly. This is now chapter 13 work, right? When we sell shares, we debit cash. We still have to credit common stock, right, with par value times the number of shares, and then the excess goes to paid in capital in excess of par value. So the debit to cash is going to be 35,000 shares times $12, right? That's the rule. Cash takes the number of shares times the issue price. Is that the number you said,
Oh, yes,
Johnny?
it is. And
Yeah,
then the
okay.
next one is
Hang on, let me catch up to you. So common stock is going to be the same
175.
35,000 times $5 par value, right?
Yes, 175.
Again, those are the rules that you follow. So if you're confused about how I know to do this, you have to go back to chapter 13. Remember that homework is due today. You got to go back to chapter 13 and read the material. You'll see that those are the rules. Cash is the issue price times the number of shares, because that's the actual amount of money that we're receiving. Common stock is the number of shares times the par value, because the par value is the minimum amount by these old laws, right, that stays in the common stock account. And the paid in capital, excuse me, in excess of par value to the common. I know this is a very long account name, but that's how the
145.
book wants it to be. You can do it 2 ways. You can plug it. So you say debits and credits have to be equal. So 420 on the debit side minus 175 gives you 245, right? That's how you derive it. That's the plug number. The other way is you can say I received $12. I'm only putting $5 into common stock. So it must mean that the remainder, right, is going into paid in capital, which is the same 245,000. Again, this should be ringing a lot of bells from the work that we did in chapter 13. Anybody have a question on this journal entry?
Can you just go to example 2 so I can check my answer?
Yeah. That's 200,000. What part of the question was a problem? Or are you okay?
Yeah, I'm okay. I just wanted to check my answer. Seems pretty close, actually.
Yeah, as long as you have the right account names, right?
I do.
Okay.
Okay,
All
that's
right.
good at least.
So going back here, so we did March the 1st, but now May the 1st, we declare a cash dividend of $1, right? But now we have to be careful because we actually want to know how many shares are outstanding on this day, because you want to make sure that you're giving everybody the dividends that they're supposed to be getting. So on
100,000.
February the 1st, we had 65,000 shares, right? And then on March the 1st, we ended up, let me do it this way. On March, it doesn't matter. March the 1st, we ended up with 35,000. So the amount of shares that a dividend will actually be paid on is the sum of these two numbers. So 100,000. I repeat, when you are paying a dividend, you have to make sure that you take all the shares that are outstanding into consideration, right? You can't just say, oh, we just issued 35,000, so it's only on the 35,000, or we started with 65,000, so it's only on the 65,000. It has to be both, because all of these people are waiting for their dividend because they all own stock in the company. Therefore, the number of shares outstanding is actually 100,000 when we make our journal entry on May the 1st. Is that clear? So clear that
Yes.
no one is saying anything? Okay.
Yes, it
So
is clear.
now we go back to this, declaration date, payment date, record date business. So May the 1st is the declaration date. So, if you want to refer back to the theory, obviously debit cash dividends, credit dividends payable. So that's what we'll do. So debit cash dividends, and you're saying 100,000 shares multiplied by $1. It's a $1 dividend per share. So $100,000 for the dividend. And then obviously the credit, this is becoming repetitive now, right? The credit is dividends payable, 100,000. That's still May the 1st, right? I'm assuming you understand that, but I'll put the date here. So this is the declaration date. You don't really have to make a journal entry for the record date. They say it's on July the 30th, but since it says only for the transactions required above, you can skip it and go straight to August the 1st. And on August the 1st, you paid the $1 cash dividend. So again, it's becoming repetitive. You're just going to debit dividends payable with the same 100,000 and credit not cash dividends, but cash, right? And
It's August the
that's,
10th.
did I have the wrong date? Sorry. August the 10th, my bad. August the 10th, thank you. Yeah, so dividends payable, debit, cash, credit, and I skipped over the July the July the 30th record date, just because it's not a transaction. I mean, you could write there no journal entry needed, but I think we get the point by now that we don't have to do anything on the record date. And this is, and I think the Wiley doesn't leave space for you to write anything for the record date in the questions anyway. So I think we're okay doing it this way. Any questions on number 3 or any part of the answer that you need me to scroll back up to so that you can see it?
Professor, can you please zoom out so we can see the whole answer in just the screen?
I'm forever too big, right?
Thank
Is this good enough or even smaller?
Smaller would be better.
Better. Okay,
Yeah.
let me see.
So
For
we can get
everything.
the,
That's the
yeah,
full
that perfect.
Monty.
Thank you.
And when the thing is this size, can you guys see anyway? Because I'm sharing my screen. You can see properly, right?
Yes.
Yeah, you can still see.
I
Okay,
can.
so maybe I should just keep it the size, because I think the issue is I'm so I'm so used to when I teach in a class, I have to make the font so huge because people have to look from where they're sitting. But I keep forgetting now that we're all in front of a device, so I don't have to make the screen so huge. All right, so I'll keep it to 90 so that everything can fit into one screen. Any other questions here, folks, on any part of number 3? All right. So I'll just give another 5 to 10 seconds if anybody's still writing stuff down. Go right ahead and I'll check the chat quickly. Nope, no one's looking for me. All right. Okay, so I think we're good here. So then the next part of the work, just notice what's happening now, right? We went through the cash dividends, we went through declaration of the dividends, the record date, which we know doesn't impact our journal entries, and then the payment date. Now we're going to just head into an example where the company actually has 2 types of stock. They have common stock and preferred stock, and they do declare cash dividend, but we are required to allocate or divide that dividend between the preferred stockholders and the common stockholders. So if you look at the notes, you see at the top of the next page, I mean, it's a very short little piece here, but I'll continue to explain as we go through. Instances may arise where a company declares a dividend, which then has to be allocated or divided between preferred and common stockholders. This allocation depends on, amongst other things, the preferred stock dividend percentage and also whether the preferred stock is cumulative or not. So just as a recap, you may recall that preferred stockholders have, as the name implies, they have preference in terms of receiving their dividend first before common stockholders, and that dividend is usually expressed as a percentage of the par value of the stock. Secondly, a preferred stock may either be cumulative or non-cumulative. Cumulative means that if we don't get our dividend in 2020, when 2021 rolls around, if the company declares a dividend, we have to get the dividend for 2020 and for 2021. So it's basically the balance keeps growing for as long as you are not paying them the dividend. And this is also from the end of chapter 13. Whatever is owed to the preferred stockholders, in terms of a dividend, but that hasn't been declared yet, is called dividends in arrears. If the preferred stock is non-cumulative, that means that if we didn't receive the dividend this year, 2020, then in 2021, we only receive the dividend for 2021. 2020 is basically lost at that point. And the preferred stockholders understand the terms of these dividends when they invest in the stock. So it's not like they are being robbed or anything like that. They know what they're signing on for. And again, just remember that the dividend is something that has to be declared in order for it to be paid out. So if a dividend is never declared, it doesn't matter how much money the company has, the stockholders cannot demand the money. They will have to wait for a dividend to be declared. I had mentioned last week that with Apple for many years, they had tons of cash on the balance sheet. And they refused to declare a dividend because they kept saying that they are using the cash to reinvest and do research and development in the company. But eventually the stockholders got so mad that they basically almost became activists and demanded a dividend, and Apple eventually gave it to them. But again, under normal circumstances, you're not owed anything. So what's happening here, this is a little bit of a tricky business. I'll just warn you, it's normally a place where where students get stuck because often they don't remember some of the things that we just discussed, that if a company declares some dollar amount of a dividend, the preferred stockholders always have to get their money first. You have to look to see whether it's cumulative or non-cumulative, and only anything that is left goes to common stockholders. Any questions here before we do an example to see how this works? All right, let me just check the chat. We're good. All right, so let's look at number 4 and see if we can figure out what's happening. So number 4, assume that at December the 31st, 2018, so yeah, I'll also warn you when you're dealing with preferred stock and allocation of dividends and things, you have to be very careful about watching out for which year you are dealing with, all right? Because remember, I said that especially if it's a cumulative preferred stock, you have to know how many years have been missed and what is owed, etc. So we're at December 31, 2018. IBR Inc. has 1,000 shares of 8%, $100 par value, cumulative preferred stock. So I'm gonna make this a little bit bigger because now I'm straining my eyes. So 1,000 shares, 8%, that's the dividend percentage, $100 par value, so it's 8% on $100. Cumulative, meaning that if they don't get a dividend in any given year, it rolls forward, right? It's owed until it's paid. It also has 50,000 shares of $10 par value common stock outstanding. So now you know there are 2 classes or types of stock, which means that if a dividend is declared, you already know that the preferred stock has to get their money first. The directors declare a dividend of $6,000. Now notice how this dividend is not an amount per share. It can't be because the preferred stockholders are a percentage, that they are owed. So it won't really, I mean, you can say, oh, we're going to declare $8 per share or something, but that's not how it works. Normally, when there are 2 classes of shares, they will just declare some grand total amount that then has to be split between the preferred stockholders and the common stockholders. So now the first question says, how much of the dividend is allocated to preferred stockholders and how much to common stockholders? Now here you want to be somewhat systematic and not just either pick numbers or shout out numbers or whatever. The first question you want to ask yourself is, how much dividend is the preferred stockholder supposed to be getting every year? Right? How do we calculate the preferred stock dividend? Because that amount is going to determine how much of the 6,000 goes to preferred stockholders. Remember, they have to be paid first. So the way we would start a question like this is to ask how much is the annual preferred stock dividend. Remember, this is the same amount every year unless you issue more shares, which in this case, I mean, there aren't any additional shares that were issued. And the way you figure this out is you're going to say the dividend percentage multiplied by the par value multiplied by the number of shares to get the total dividend amount per year. So in this case, in the question, the dividend percentage is 8%, the par value is 100, and the number of shares is 1,000. So you're going to say 8% times $100 times 1,000 shares. Now you should be asking again, if you got lost, you're saying, why are we doing this? Because we actually want to see how much money we should be giving preferred stockholders every year. And as you can see, it comes to $8,000 per year. And remember that this preferred stock is cumulative. So it's not, use it or lose it. It's if we don't get paid this year, we have to get paid, in some subsequent year, whatever is still owed to us. Does anybody have questions on how to arrive at this 8,000 or what it means? Okay, so now you know what the preferred stockholders are quote unquote supposed to get, right? Based on the terms of the preferred stock. And you have to compare that now to the dividend that was actually declared. Immediately we can see that there is a problem. What is the problem?
We're short 2,000.
Yeah, we're short, right? So the dividend that is declared, is 6,000. If preferred stock already should get 8,000 and the dividend is less than the 8,000, then it means that if we're talking about an allocation, the preferred stockholders are going to get the entire 6,000, right? They have to. And then there's still a problem because 2,000 would still be owed, right? In the next year. What does common stockholders get? How much does the common stockholders get? Can we pay out more than we declared?
No.
No, you're right. Can't pay out more than we declared, so they get a big fat 0. How do you feel about that?
Broke.
You feel broke?
Sad face.
Yeah, sad face, right? So, but this is the nature of common stock, is that especially if there's preferred stock in the mix, it's kind of like a residual interest, almost like how we spoke about owner's capital back in the day when we were doing partnerships or sole proprietorships in accounting 1. You get whatever is left over. Even if the company liquidates, it's the same thing. The creditors get paid first, so liabilities would get paid first, preferred stockholders would get paid second, and then the common stockholders would pick up anything that's left over. Now, this is super sad face, right? Because you're getting 0. But remember that if the dividend had been $60,000, for instance, right, then the preferred stockholders would only get 8,000, and the common stockholders would get the rest, which is 52,000. So sometimes it's, you know, not great for them, but other times, depending on how much is actually declared, they could actually really walk away with a lot of money. So it's kind of the risk that you take to be a common stockholder, that when the going is good, it's really good for you. And when the going's not that great, then, you know, you kind of suffer a little bit. So that's the allocation. So number 2 asks us to prepare the journal entry for the dividend declaration. So it's the same thing as before. I don't want you to get confused now because we're splitting the dividend and paying, you know, paying preferred stockholders. It's exactly the same journal entry as before. You're going to debit cash dividends with the 6,000, the whole 6,000, because it's still what's owed, and credit dividends payable with the same. There's no, you don't have to show like dividends payable to preferred stock or something like that. I think in the book also, they just call it dividends payable. You've already shown in your calculations who should actually get the money. Questions on the journal entry number 2? All right. So then we come to number 3, and excuse me. So in number 3, we've moved on to, do you see here? This is the following year. Okay. And just remember what I said, 2,000 is owed to these guys in the next year, which is 2019, right? Because we were in 2018 for the first part of of this question. So they got 6,000, but they're still owed 2,000 because the stock is cumulative. All right, so at some point you have to settle their entire amount. So if you owed them 8,000, you only declared 6,000, 2,000 is in arrears and will keep rolling forward until it gets paid. At December 31, 2019, the following year, IBR Inc. declares a $50,000 dividend. See, the number got much bigger now, right? It was 6,000 before, now it's 50,000. How much of the dividend is allocated to preferred stockholders and how much to common stockholders? So this is where I'm going to throw you into the deep end. Don't shout out anything. I mean, if you have a question, ask a question, but I'd like you guys to just take a stab at trying to figure out, right? If the dividend declared, sorry, for 2019, I don't know what's going on with my typing today, is 50,000. Take a stab now at the allocation for preferred and common. And I'm going to give you, let's go until 11:50. So you have 8 minutes to try and figure out how much of this money is going to go to preferred and how much to common. And again, don't scream out the answer, just let people try and figure it out. This is again a part of the work where people struggle a lot, so I would like everyone to just take a stab at actually doing this allocation. So you have until 11:50. I'm just also doing the attendance while you do this.
Hi.
Say hello, Adrian. Say hello, everybody.
Hi, everybody.
Okay, buddy. Okay, bye-bye. Say bye-bye.
Bye-bye.
Mia, Mia.
Bye.
Mwah. Okay, bye-bye. That was my son.
Too cute. Okay, one more minute before we go over the solution. All right. So how did you guys do with your first dividend allocation?
Preferred stockholder is 10,000.
I say yes. Can you walk us through what's going on there?
So basically they declared there was a 50,000 and then they owed 2,000 from the previous year of
Okay,
2018.
let me catch up. So preferred stockholders from 2018, sorry, we bring down the 2,000. Remember, whatever is owed from a prior year is going to be paid out first. So yes, you bring the arrears, as they call it, right? 2018 arrears is going to go first. And then you said, and we all recall that every year the preferred stockholder dividend is 8,000, right? So 2019's dividend is 8,000. So we still have enough money to pay them that, bringing us to your total of 10,000. Anybody have questions there before we move on? It's too easy. No? All right. I check
And the
that.
common stockholder gets 42.
The remainder, exactly. Okay, I'll answer that. So common, why is my computer doing this? So common stockholders will be 50,000 minus 10,000, which is the 40,000. and together they have to add back up, sorry, to 50,000. 10 plus 40, sorry, me just do not disturb. Okay. Right, so that's how we allocate. So now let's think about the steps that we just followed, right? When you get a question like this, the first thing that you want to be asking is, how much is the preferred, and I'll come back to the answer, so don't panic, you'll be able to take it down. How much is the preferred stock dividend per year? Right, that's the first thing that you want to calculate. Then you want to ask, is it cumulative or non-cumulative? Because that's going to determine whether when we don't pay them the entire dividend, whether an amount is still going to be carried forward to another year, right? And then you can start saying, okay, how much is the dividend that was declared? In our previous example, the dividend was only 6,000 and the preferred stockholders annual dividend is 8,000. So the entire 6,000 goes to them with 2,000 still owing, right? And then the next year, the company declares 50,000. So that means we can get rid of this owing amount of 2,000. You can also pay them the current year's dividend of 8,000, giving you the 10,000 total. And then anything that's left over goes to common stockholders. Notice how in the prior year, the common stockholders had 0. And now in this year, they receive this massive amount of 40,000. And again, that's the nature of the common stockholders. They kind of get what's left over here. So it might be a really small amount or it might be a really big amount. Any questions, anybody? All right, so I'll give you a few more seconds for anybody who still needs to write this down. And then just to remind you that we do have questions like this in the homework. So please pay attention to the process. Let me say this now, right? If the preferred stockholder, if we assume, right, or pretend, which is even a better word, so you know this is not in the question, that they were non-cumulative, okay? Then if the preferred stockholders were non-cumulative, we would not pay any arrears for 2018. You would only pay 8,000 for 2019. The total that they would get would also be 8,000 and the common stockholders would get 42,000. All right, this is if the preferred, oh no, that's not what I meant to do. This is if the preferred stockholders were non-cumulative, you wouldn't have to pay anything that was unpaid in a previous year. And then as soon as you've had a minute to just process this and write down anything that needs to be written down, we can do the last part. So in the fourth piece, they just ask you to prepare the journal entry again for the dividend declaration. This is going to become kind of, you know, almost boring in a way because it's the same thing over and over. Since it's a cash dividend, you're just going to debit cash dividends. They're asking specifically about the $50,000 dividend. So you're going to literally debit cash dividends 50,000 and you're going to credit dividends payable 50,000. I mean, again, there is this option of trying to split the dividends payable between common and preferred. It will really depend on how the company does their books. Many companies will just have one dividends payable account. So you can just write here, preferred is 10,000 and common is 40,000. thousand, in case someone wants to know just by looking at the journal entry how much money is going to each class of stock. After you guys take this down, I'm just actually going to go into the textbook and try and figure out. Oh, hang on. I need to plug in my computer. 1 second. Yeah, after you guys take this down, I'm just going to go into Wiley to see, I can't remember exactly what their preferred approach was to answering this question, if they want you to split it or keep it as one. $14. Yeah, they do the same. They just do one account. This example that we did is the same as what's in the textbook. And then in the narration, they just put the split between the two. So you don't have to divide the dividends payable account into, dividends payable for preferred stock and dividends payable for common stock. You can just go with, where am I? We can just go with what we were doing, just one dividends payable for 50,000. Any other questions here? All right, so it looks like there's no questions. So why don't we take a leg stretch or whatever you want to call it for until, I guess, maybe 12:10. Just take a quick break. Maybe just make sure that you have all your notes up to date. I'll step away for maybe 2 minutes and then I'll come back. And if people have questions for me during the break, I'll take them. All right, so I'm going to pause the recording, not the sharing. All right. The allocation of the cash dividend between the preferred and common stock is probably the trickiest part of the cash dividend piece. So make sure that when you are doing that homework and so on, that you pay particular attention to whether the preferred stock is cumulative, non-cumulative, and so on. So for the stock dividends, that's the other type of dividend that I said we would be focusing on. This is also a part of the work that I generally find people get stuck on a little bit because there's a particular way that a very systematic way that you have to calculate the stock dividend. And most of the time, I think the problems come in because people don't actually study the rules on how to do it. So you can get really stuck. The stock dividend is obviously not a cash dividend, which means it's not going to be some dollar amount declared. It's actually going to be a number of shares that will be issued as the dividend. So per the theory, a stock dividend is a pro rata. That means a proportional distribution to stockholders of the company's own stock. So if I'm a stockholder in this company, they may decide that they're not going to pay a cash dividend, but they do want to give me something. So they're going to give a stock dividend. And what are some of the reasons for that? If you go into the textbook, you will see that they discuss why a company may do that. One is to satisfy the stockholders' dividend expectations without spending cash. So this may be a company that has, paid dividends for many years, and maybe they've run into some trouble and they won't be able to actually pay a cash dividend, but they still want to appease the stockholders to some extent by giving them something. So instead they issue stock. Believe it or not, if a a company has a history of declaring dividends every year or every quarter, and they suddenly stop doing that, it has a massively negative effect on their share price. So companies would always want to, not always, but I mean, would want to avoid any negative impact. So they may just issue a stock dividend because they don't have the cash to actually do a cash dividend. They also possibly want to increase the number of shares outstanding. So remember, when it's a stock dividend, we are issuing more shares, which means that there will be more shares available on the stock market, which also means that the price of the shares will decrease. The market price of the shares will decrease. So decreasing the market price of those shares will actually mean that maybe more people will be able to buy the shares in the future, or smaller investors, people like you and me, might be able to afford these shares. This is not going to negatively impact people who already own the shares, because you're still, you're receiving stocks in proportion to the number of stocks you already own. So your holding will stay the same. It's just that overall the stock price is going to go down a little bit. And then the company may also just be trying to send a message that they are basically using the dividend as an opportunity for reinvesting in the business, that this amount is going to be in stockholders' equity, and so it won't be available to be paid out as cash. Right. So again, those are some of the reasons why a company would declare a stock dividend. Let me just go back to the notes here. And what are the impacts of a stock dividend? Retained earnings decreases again, because even though we use the account name stock dividends, this account eventually closes off to retained earnings. So it's decreasing the amount of retained earnings that's available for future distributions, which makes sense because we are distributing the amount now. But instead of a decrease in cash, like we saw with cash dividends, a stock dividend is actually going to cause an increase in paid in capital, right? So if we go back to, I'm just gonna pop back to chapter 13 and look at that balance sheet again that we were studying last week, to just remind ourselves what we're talking about. So here's the balance sheet. Here's retained earnings. The dividends eventually cause a reduction in retained earnings. For a stock dividend, you're not going to have cash go down. You're actually going to issue more shares, so the common stock number will go up. And if those shares are issued in excess of the par or the stated value, you will also have more, additional paid in capital. And remember, this is called paid in capital, right? So the common stock and the paid in capital in excess of par. So when you, look at what this is saying, a stock dividend will increase your paid in capital because common stock and paid in capital in excess of par or stated value will go up. There will be no impact to cash. All right. Stop me at any time if anybody has questions. And then I already discussed for you what some of the reasons are why a company would do this. And obviously we're working with an electronic book here, so this page number may not be relevant anymore. Stock dividends, when they are declared, they are expressed as a percentage of the number of shares outstanding. Very important here, okay? So it's not a percentage of par value. It's not a dollar amount per share. It's a percentage of the number of shares outstanding. And this is why I said it's so important to kind of follow what the theoretical approach is to calculate this, because that's the only way you're going to get these questions correct. Stock dividends may be small, that would be percentage of shares outstanding up to 25%, or large, which is more than 25%. We're only going to focus on small stock dividends. So when you get given a question, the percentage could be anything up to 25%, but not more than that. For a small stock dividend, the value assigned to the dividend is the fair market value of the share. So think about what's happening, right? The company is saying, we want to give you a dividend, we want to do some type of distribution. It's not going to be in cash, it's going to be in stocks. So if you say, well, I actually wanted cash, right? I didn't actually want more stocks, I wanted cash. What you can do is you can turn right around and take the stocks that were distributed to you in the dividend and actually sell them on the market. Right, at fair market value. So if that happened today, and let's say I wanted, and I got a stock dividend, a stock dividend from Google. So Google stock is trading at 1,153.88 per share. The stock market is up a little bit today. People are feeling somewhat, I guess, more hopeful. And so maybe Google gives me, I can't afford a lot of Google shares, so maybe I only own 2 shares and I get another 2 shares. I say, well, actually, I need this money right now. I don't want more stocks. So what I can do is I can turn around and sell my stocks in the market at this price and actually take the cash for myself, which is why we price, sorry, I'm in the wrong thing, which is why we price the stock dividend at fair market value, because we're saying anybody who wants to can actually turn around and go and sell those stocks at the market price of the shares. So it's not going to be par value or some other number. It's going to be fair market value that we use in the calculations. Any questions, excuse me, up to there before we actually look at how the journal entry runs? All right. I'm taking silence as meaning either everybody or most people understand or everybody's thoroughly confused, right? We shall soon see. So on the declaration date, so we're trying to follow the same pattern, right, as what we were doing with cash dividends. What's the journal entry on the declaration date? Is there a journal entry on the record date? What's the journal entry on the issue date? So declaration date, here's the difference already, right? The debit doesn't go to cash dividends, it goes to stock dividends. How do you determine the amount that has to go in as stock dividends? It's the number of shares in the stock dividend, okay, which we still have to figure out how to calculate that. But just remember, it's the number of shares in the stock dividend multiplied by the market price of the shares. The market price of the shares is the same as the fair market value of the shares. So remember what I was saying, if I got a share in let's say we did a stock dividend for Google and it's 1 share in the stock dividend, and the market price, so since the market price was 1,153, this number would become 1,153. Okay, that's what we mean. Obviously, Google isn't going to do a stock dividend of just 1 share, but I'm just trying to show you what that means. So number of shares in the stock dividend, which we will calculate based on the percentage of the stock dividend and the number of shares outstanding, then multiply that by the market price of the shares on the date of the declaration, right, of the dividends. Notice here that you don't have a dividends payable situation because there's no cash to be paid. Instead, you use an account that is also kind of like a holding account. You can't do a credit to common stock immediately because you have not yet distributed the shares, right? So it would be wrong to credit common stock. So instead of crediting common stock, you credit this account called common stock dividends distributable. All right, and that is going to be credited with the number of shares, again, I should be more clear, in the stock dividend, right? So the number of shares in the stock dividend multiplied by the par value of the shares. So you can see here again, there's kind of this similarity from what we were doing before, where we use the par value for the common stock piece. But again, this account is a temporary account that we use until we distribute the shares, which happens later. And at that point, we switch over to common stock. And then the last piece is the paid in capital in excess of par value or stated value, which will be, a plug number. You can record the paid in capital in excess on the declaration date because that isn't dependent on the stocks actually being issued yet. So you are allowed to use that account. And so, when you look at this, you might be thinking about the journal entries that we have for stock issuance, and you should be thinking of it that way, except, of course, there's no cash here. The cash is replaced by stock dividends, and also you don't go for common stock immediately. It's common stock dividends distributable. Questions here before I go on? All right, and they tell us that common stock dividends distributable is a stockholders' equity account shown in the balance sheet. So let me show you here in chapter 14 where you can actually see that, so that it might help to understand how this thing appears on a balance sheet. Bear with me. So that's how it looks, right? So you remember from when we looked at the balance sheet before, we start with paid in capital. We're supposed to be capital stock. Then we have common stock. And then right below common stock, you will just write in the common stock dividends distributable account, all right? So it is part of paid in capital in the balance sheet. And so on the record date, it's the same as with the cash dividend. There's no journal entry to be made. You are simply going to see who actually owns the shares. All right. And then on the issue date, notice how it's not called a payment date. It's an issue date because you are issuing shares at that date. You're distributing shares. What happens is you remove the common stock dividends distributable account, which is a normal credit balance. You now debit it. In its place, you will recognize common stock because the shares have in fact now been issued. So all that happens when you have a stock dividend is that you, in the end, transfer money within stockholder equity. You take it out of retained earnings because remember, earnings. So the money is coming out of retained earnings and goes into common stock and paid in capital in excess of par value. Very involved, very complicated concepts. So what can I repeat for you before we try to squeeze in at least one example here? I highly doubt that my explanations are so great that no one has a question. But apparently, this is where we are. Do you guys just want to try?
I feel
Yeah,
that we're just waiting for the
You're waiting for the
exercise
example.
to come, and then we can see if we
Okay,
understand.
got you. No worries. I'm all for that as well. So we're gonna do number 5 together, and then the questions will flow, I'm sure. All right. So number 5 in the stock dividends section of our chapter 14 exercises. On December the 31st, 2018, Medland Corporation has a balance of 300,000 in retained earnings. All right, so what this is kind of telling us is that they do have retained earnings available in order to, be able to declare a dividend, whether it be a stock dividend or cash dividend. Remember that both cash dividends and stock dividends decrease retained earnings, so we need to have retained earnings available. It declares there's the crucial information, a 10% stock dividend. Remember we said from the theory that the stock dividend is expressed as a percentage on all the shares that are outstanding. So there, on its 50,000 shares. So 10% on 50,000 of its $10 par value common stock. So there's your par value. You will need that because remember, as part of the declaration journal entry, you use par value. There's more information that you need. Remember, we said if it's a small stock dividend up to 25%, you use the fair value of the stock to price the stock dividend. So the fair value for this company stock is $15 per share. Medland issues the shares on January the 2nd, 2019. So that's the issue date. So this question takes us step by step to get to the journal entry for the dividend declaration and also for the issuance of the stock. But what I will say is sometimes the way these questions are phrased, they actually just ask you to do all the required journal entries, and you kind of have to know to do the declaration and the issuance and how those journal entries run and how to get to the amount. But so for us now, the first question is how many shares are issued, right, as the stock dividend. So I'm going to go to this sheet over here and start calculating this. So this is example number 5, and within that, number 1 is asking me how many shares are in the stock dividend. And how did we say we calculate that? It is, sorry, I keep doing this. I need to put this at the bottom. It is a percentage of the number of shares outstanding. So if we look at the question again, 50,000 shares outstanding, 10% dividend. So it must be 50,000 shares times 10%. And remember, it's the shares outstanding on the date of the dividend declaration. So you have to make sure that you are actually looking at the correct date. So 5,000 shares. So again, this is the formula is the number of shares outstanding on the dividend declaration date multiplied by the stock dividend percentage. That's the formula that you can use to calculate how many shares are in the stock dividend. So obviously that's not the answer in terms of the journal entry yet, but we at least know how many shares we're working with. So now we come to the second question, which says, prepare the journal entry for the dividend declaration, right? And so if you, and I'll come back to this now because I know some people might still be writing stuff down, but if you go back here, this is your hint on how to prepare the journal entry, right? That's what should be in the journal entry. So we're gonna have, let's move this over, debit and credit. And so the first piece is to debit stock dividends, right? And if you're completely lost on a question like this, at least you should know which accounts are involved in the journal entry, and then hopefully you can work to try to figure out the amounts that you have to put in. So the rule that we have with stock dividends is that you're going to take the number of shares in the stock dividend multiplied by the fair market value of the shares. And if we go back here, we would, or market price, fair market value and market price mean the same thing. We were told that that is $15 per share. So we're going to take 5,000 shares and multiply it by 15. And remember, per my example for the Google shares, the reason we do this is because we we know that if people don't want to keep the shares, they can go and sell the shares immediately on the market. So the value of the shares is, in fact, whatever the market price of the share is on that day. Questions up to there? All right. So now we come to that. Sorry, I'm trying to give myself space because I know the name of that account is really long. So now we come to what do we credit? You go back if you forgot. You look at the theory. Common stock dividends distributable is the account that we need to credit. So I'm just going to do a abbreviation so that I can actually fit this in. Common stock dividends distributable. And how do we calculate that? I'll just write it at the bottom here. It's going to be the number of shares in the stock dividend multiplied by the par value of the stock. And if you look in the question, it says that the par value is $10 per share. So you're almost going for the same formula. Well, not almost. You're going for the same formula that you would use for common stock, right? Number of shares times the par value. And so that's 50,000. And then the last piece is obviously the paid in capital in excess. And in this case, it is of par value because the shares have a par value for common stock. And you are going to, you can plug, you can say 75 minus 50 is 25,000, or the long way, if you want to prove it to yourself, is to say, I got 15, par value is 10, and I multiply that by 5,000 shares, which still also gives you 25,000. Questions, anybody? All right. I'm going to skip over 3 just because I actually just want to, 3 is asking us to prepare the whole stockholders equity section. It's not that it's not important. I can come back to it, but I mean, we literally have like 10 minutes left. I actually just want to prepare the journal entry for the stock issuance so that you can see how that, you know, ends up looking. And then I'm hoping, this is probably excessive, but hoping that in the last 10 minutes you guys can actually attempt number 6. So I'm going to do 4 over here, which is the issuing of the stocks on January the 2nd. So just put January the 2nd over there. So if you recall from the theory again, if you look at the issue date, what happens is you basically just flip out or swap out the common stock dividend distributable that was a previous credit. You're now going to debit it to get rid of the balance in that account. And in its place, you will recognize common stock because that stock has actually now been issued. All right. So we're going to debit common stock dividend distributable with 50,000 only, and you are going to credit common stock 50,000. And that's it for the declaration and the issuance of the stock dividend. I will remind you, because we may have to do this next time when we get together, but I'll remind you that the common stock dividend distributable account is just going to be another line item in paid in capital, okay? And it just stays there until we eventually issue the stock. So let's push a little bit here and say, let's have you guys try for the last few minutes that we have to see if you really understood what went on here by trying to do number 6. So I'll read it with you, and then you can do the journal entries. So Langley Corporation has 50,000 shares of $10 par value common stock outstanding. So there's the number of shares outstanding, the $10 par value, very similar to the previous question. It declares a 15% stock dividend. So there's your dividend percentage that you need to apply in order to figure out how many shares are in the stock dividend on December the 1st, when the market price is $16. So there's the market price that you need as well. Remember, it's a small stock dividend, so you base it on the fair market value. The dividend shares are issued, so that's the issue date on December the 31st. Prepare the entries for the declaration and for the payment of the stock dividend payment here, just meaning the issuance of the shares. So what I'll do is leave this up. Hopefully it's all small enough so that we can have the entire solution showing. I'll leave this up, and then I'm going to ask you in, the next few minutes, 7-8 minutes, to just try and see how far you can get with number 6 in doing the declaration and the issuance of the stocks.
Can I give it a shot?
Not yet. Let's say in 2-3 more minutes, I'll call on you, okay? All right. So you may not be done yet, which is okay, but I don't want to keep people past the time. So let's go through number 6. So Jeremy, you want to tell me how many shares are in the stock dividend? How do we calculate that?
The answer is 7,500. And how did I calculate it? It's basically 15% times 50,000 shares comes
Yeah.
out to 7,500.
So 7,500 shares. So that's always the first step that we're going to take, is to figure out how many shares are in the stock dividend. You really can't move forward without knowing that number, because every other calculation is dependent on having that information. Now we can make the journal entries, and so we're going to say debit what year for the declaration date. Do we have a date? It's December the 1st. Okay. Okay, so go ahead.
And then next it will be 7,500 shares times the market fair value. The
Which
market price
is
is 16.
$16. So you're going to debit stock dividends. You're going to say 7,500 shares times $16, 120,000 is your stock dividend. Sorry, I don't know why my computer's acting like this today. And then you need the common stock, common stock dividend distributable. Beautiful. This you're going to take the number of shares in the stock dividend times the par value of 10. Okay.
75,000.
So 7,500 times 10 is,
and then the remainder is 45.
Paid in capital in excess of par value, common stock, plug 120 minus 75 is that what you got? 45,000.
Yes.
And you can do it the other way, 16 minus 10 times 7,500 shares. Either way, you're coming to the same. Questions, folks? Let me check the chat to make sure I didn't miss anything. All right, so it seems that the silence is telling me that maybe people know what's going on with stock dividends, which is very encouraging, because like I said, it's a bit of a rough topic. One thing that I want to point out before my time runs out with you is you have to look at the number of shares outstanding on the date of the dividend. All right. Sometimes a question will start with saying, you know, at the beginning of the year, they had 50,000 shares, then they issued another 20,000 shares, and then they declared a stock dividend. Be careful, okay? Don't just take the 50,000 shares from the beginning of the year. You have to add any shares that were issued in the time before the stock dividend, all right? So that's why it's important to say how many shares outstanding on the declaration date, because on that date you may have had previous stock issuances, and that number of shares has to be included in your calculation. You can't just ignore it. So I'll just write it here at the risk of going over time. Let's say on January the 1st, I'm just making up stuff, right? On January the 1st, you had 40,000 shares outstanding, and then on March the 1st, you issued another 20,000 shares, right? And then on June the 1st, let me move this up. Then on June the 1st, you declared, right, a 10% stock dividend. So now on June the 1st, how many shares are outstanding? Not 40,000, not 20,000, but 60,000 shares, right? Outstanding on that day. Be careful of that. Because sometimes people just go with the first number they see and make that into, you know, the shares outstanding, and then that's wrong. So that's where I'll end it. Remember, we do have my chat, right? There is office hours. 463-614-368 is the ID. Once we end this meeting, you'll lose the code, so it's also on Blackboard. But that's it for today. That's also it for now. I'll only see you back again on the 20th of April. So enjoy your spring break, such as it is. If you are engaged in any faith practices, if it's Passover, I wish you a peaceful Passover. For those of us who celebrate Easter and Good Friday, I wish you a blessed time. And for those who are celebrating spring, enjoy this time of renewal, and I hope that everybody will stay healthy and safe in this time. So goodbye. See you soon. I'll miss you guys. Yes, Jennifer's asking if I've marked you present. Absolutely. Everybody who's on this call has been marked present, so don't worry about it. All right, you are in. Don't forget the chapter 13 homework is due this evening, 11:59 p.m.
My brain is absent.
I think it's understandable, but we help each other, okay? You're fine. I think you're fine. And even if somebody's brain is absent, remember this thing is recorded, so you can always listen again at another time. Cheers, guys.
Take care,
Thank you,
everybody.
Professor. Have a nice
Bye.
Wednesday.
You too.
Take care. Bye-bye.
Bye.